All right. Hey, everybody. Welcome back to our Facebook Live interview series. This is actually our 4th episode. We've been lucky enough to have some really great guests the last few weeks. And again, I'm thankful that we're joined here today by Christopher Caproni, RPM Mortgage. We are here at his beautiful offices in Mill Valley, California. So quick apology. We're supposed to start at 11. We had some Wi-Fi issues, so you can blame it on the technical difficulties, not on us.
The redwood trees.
Yeah, blame the redwood trees. There's too many of them. So, but we're here today. As we discussed in some of the preview and promotion to this topic, today we're going to focus a lot on buyers, and we have several myth-busting type questions that we're going to ask of Christopher, and he's going to dive deep and kind of walk us through how he thinks about how buyers can compete in today's environment. So I'm super excited about that. Before we get into it, just want to remind the audience, we do want to make this as interactive as possible. So anytime you have questions or want clarification on any point that's made here, feel free to drop it into the questions and we will address those as they come about. So let's get into it. Again, I gave a brief introduction of Christopher there. But Christopher, for the audience who's watching us and who will watch it later on today too, kind of give us your background, kind of how you got into the business, how long you've been in the business, what you're so excited about today, everything we need to know about you.
And we can do all this in 15 minutes. Outstanding.
That might be a all-day topic on that question, but we'll see.
That's my challenge. All right, keep it simple. First of all, I've been a resident of the Bay Area since 1976 from the East Coast, and made the migration. I married a local girl. We lived in Mill Valley since 1986. We've owned our first home then. Since then, we've managed properties. I was a property manager, so I came to the business a roundabout way as a homeowner and a property manager, and we now do VRBO and Airbnb, so we're very familiar with ownership as well as the rental side of the market, and investment properties as well. I came to this industry 5 years ago from technology leasing, IT equipment, and I've been in corporate sales, negotiation, training for my entire career. I started with Eastman Kodak Company. Back then, that company, if you were relocated, had a relocation department that would guarantee the sale of your property, even in a down market, when you relocated to corporate. So my wife worked for IBM. She's my production partner in this business now. We happened to meet Bradley at an open house in Tiburon, and the rest is history. The reason I came to this industry, frankly, is I looked around when I left technology leasing at where the growth markets were. And I realized that real estate would always be in demand, whether it's primary residence, second home, or investment property. And I looked at the Bay Area versus other parts of the country. The demand is so strong here. You look at the population of our state, you look at the demand for housing, you look at what's done to the housing prices. And at the end of the day, I've lived through a few earthquakes too. So I always say to homeowners, if you don't like the way prices are escalating, you can always leave the area, or an earthquake will level the playing field for all of us and we'll start all over again. So the reality is we live in the most beautiful place in the world, in my opinion, but it does cost. So I'm grateful for the opportunity to be invited to participate, and we are going to talk about some of the myths that I think exist in our industry today. Do you want me to touch on those, or?
Yeah, so let's kind of tee it up for the audience right now, and I'm sure that you get these questions all the time, and as do I. So that's kind of some of the origin story around why I wanted to bring this to Facebook Live and just try to reach as many people as possible at scale. So we're going to cover, as you alluded to, a lot of these myths that buyers have today. And the first one is, especially in the Bay Area, with all the Facebook millionaires and all these other millionaires out there that have cash on hand ready to purchase these properties with, a lot of people who aren't as fortunate and so are borrowing money to purchase a home, they wonder how they can compete with cash. And I know RPM has some interesting programs to address those issues. I'd love for you to take that on there.
Absolutely. We probably caught the news the other day about the young millionaire, 30-year-old, who paid $28 million in Pacific Heights for a home. These are certainly the exception to the rule. In today's market, in order to compete with cash, historically a lender had to do a full underwritten pre-approval. And when I came to the market, there were a few lenders doing that. Not everybody could do it because it takes resources to fully underwrite a file when a client hasn't yet gotten into contract. But RPM announced at the beginning of the year a program called Advanced Approval. And what that is a fully underwritten TBD purchase. And in order to do it, you complete a loan application with us. It takes about 15 minutes. Then you can upload your application materials to a secure website we have. And then typically within 7 days to 10 days, we have a fully underwritten file. And we issue that to your agent and to you, and you can go then shop with confidence, meaning that you know you're going to get your loan funded. In conjunction with that, we have a guarantee called Home on Time Guarantee. That means if we don't fund the loan within 25 days or less, we refund the client's lender fees, which is significant. It's just under $1,400. Now, the reason that we offer this program is we realized that many of the buyers we were representing were having to offer 2, 3, 4, 5 times, and they were losing the cash, as you mentioned earlier. When you have a program like this, you may go in contingency free if you wish. Number one, you can go in without a loan contingency, which is typically 17 to 21 days. Secondly, you may go in without an appraisal contingency, but that is one that is strategic, and I don't recommend that for everybody. So the other thing that we offer is low down payment programs. And for anybody who's a VA or veteran, there is a 0% down program, which is wonderful for the VA. And there are limits in these loans in terms of the maximum loan amount here in the Bay Area. Secondly is the FHA loan at 3.5% down. Then you have conventional conforming at 5% down. The FHA loan and the conventional conforming do require the borrower to have mortgage insurance as well, which can be another 10 to 15% on top of the normal payment. The last thing I want to mention is we do have an incredibly good program that I've had a number of clients use, and it's called First Rex and Rex Homebuyer. First Rex is a partner of ours. They're based in San Francisco. They're a private company. They've been around since '04, so they've weathered the downturn. But what they do is they invest in the down payment right alongside the buyer. So if a buyer has 10% down and they need to get to 20 to not have mortgage insurance, then Rex will, once they've vetted the property, they will approve to match the down payment. So they'll put in 10%. Now this is an investment. There is no loan, there's no mortgage payment. And the way that Rex gets the return on their investment is once the homeowner sells the property or possibly refinances it and takes Rex out. They pay off the original investment and then a share in the change in future value. Not the equity, but just the change in future value on the property. So a little bit complicated, won't try to go into it here. I will also tell you this, that under the Rex program, we can seek exceptions for gift funds. So I'll give you an example. If a borrower has 5% of their own funds, they can match it with 5% gift from a parent, possibly grandparent. They can get to 10%, Rex will match them, get them to 20. So the reason I say myth busting is there's a lot of misconceptions about what it takes to buy a home today in the Bay Area. A lot of people who couldn't can now with programs like this. Okay.
And we're actually going to talk about First Rex a little bit later on in this interview as well. But going back to one of your first points about the advanced approval and the home on time guarantee, that's very interesting to the audience, I'm sure. For the advanced approval, like you said, Christopher, it's almost as good as, or just as good as competing with cash. The file for the client has been put in front of the underwriter. They reviewed it. Are there any considerations that a buyer considering going with that program should be thinking about? Any gotchas? Anything that they should be concerned about? Because it does sound pretty good to be true.
No, but I would say the same thing I'd say to any borrower preparing. I would say, once you've gone through the process, it's good for 90 days, the approval, by the way. So once you go shopping, if it's done right, I'm convinced people can get into contract within 30 days or less and close in under 90. But the only caveat would be don't open up any new lines of credit without talking to us first. Don't quit your job. Okay?
Don't get that new car.
Don't get that new car. Don't go to Best Buy and open up a line to buy new appliances.
Don't get on new furniture just yet.
No.
Yeah.
No, and try to stay, well, try not to change anything at that point, at least until your escrow is closed, okay? There are very few cases today where somebody does make one of these mistakes, but it does happen. They get an opportunity to travel and check their bags for free, so they get a United Mileage Plus card, and they put their first trip on it. Now, that in itself won't kill a transaction, but it will cause a delay. And if we want to use our home on time guarantee and close in 25 days or less, which we're doing about 99% of the time, by the way, there could be a delay if you do something like that.
Yeah.
Okay. So we will honor the guarantee as long as it's within our control. If something happens outside of our control, we can't guarantee that.
An interesting topic that we're also going to cover is credit. A lot of times people may in the past have had blemishes on their credit report or things that they want to things that are affecting the amount that they're able to borrow or the rate they're getting. For someone preparing to buy in maybe 6 or 12 months, kind of what are some of your tips around getting your credit in order?
Yeah, there's a lot of misconceptions around credit. And by the way, I don't have all the answers, but we have a number of wonderful partners that we work with. The first misconception about credit is that people's scores are better than they think they are because they've got maybe a credit watch on one of their 3 bureaus, and there are 3 that you need to know about. Our industry pulls a tri-merge report from TransUnion, Equifax, and Experian, and they look at over 300 data points when they pull these reports. But the first thing I would say if you're preparing to buy is know your credit, know where you stand. Know what your assets and liabilities are. Know if you've got any red lights. Okay, I use the analogy back to preschool days of red light, yellow light, green light. And my goal when I meet a client and help them prepare is to find green lights all the way through close of escrow and possession of the house. If there is a yellow or a red light, we have to deal with it. A yellow light could be something reported on the credit report that can be a letter of explanation can cover in underwriting successfully. Something that would be a red light would be a bankruptcy, a short sale, or foreclosure, and those events, or a public filing. And there are some clients I've worked with who did not know they had a public filing. They thought they'd cleared it up. They thought that the deed had been recorded or something had been cleared, and it hadn't happened. And they never pulled their credit report again to realize it hadn't.
And the timing couldn't be worse too, because now they're preparing to get that home of their dreams, and then this thing from their past comes back up that they had thought had been cleared up, but they didn't actually check.
That's right. Call it a landmine or a roadblock. But many times you can get through these things in 30 days or less. The other area that we counsel clients is if their FICO score is not high enough to qualify for one of our programs, whether it be an FHA loan, a conventional loan, or Rex Home Buyer that we'll talk about, or something else, is to be able to show them, here's where your score is today. We run a what-if simulator that says, here's where your score needs to be, and here's what it's going to take to get there. I call this the strategic use of debt reduction, because you may have to take some cash in your savings and pay down some debt strategically to get your balances on your credit lines lower, to be able to improve your score, to be able to get a program or a better interest rate. Okay?
And what, for the audience out there, what do you consider, what's a good credit score to have?
Well, the minimum would be, for the lenders investors we work with today, Fannie and Freddie, would be 620. Okay, for some of the programs that first-time buyers may want to use, it's probably going to be 700 or 720. The best score you can have is 850. I just priced a loan the other day at 820 on a refi. You get a better interest rate, you get fewer loan reserve requirements, and it's just better all around if you can have a cleaner credit score. But we realize not everybody comes into this world of buying a home with a clean score. The other thing is we're running in, of course, student loan debt.
Yep.
Okay. Some of these things can or should be paid off. A car loan, for example, versus a car lease. People don't necessarily understand the difference, but if you have a car purchase loan and there's 9 payments or less remaining, we don't have to include that debt in your debt to income calculation, which is very helpful. So if you're close to 9 or less, maybe pay down from 14 payments remaining to 9 or less remaining, and you can eliminate that $500 payment, qualify for that loan. These are little tricks that I've learned, and I got a lot of successful colleagues around me that I turn to when I have questions too.
And so what I'm hearing, Christopher, is that there's opportunities out there to be very strategic in how you approach the purchasing process. So it's actually looking at the entire financial picture, the assets, the credit, the income, the debt, everything, and try to figure out based on your particular puzzle pieces, or maybe chess pieces, what's the best move to make that's going to get you into the home you want.
Yeah, I say to clients is we're going to use the least amount of money to get the best amount of return for your investment when I'm talking about credit improvement. We do counsel in this area. We don't do credit cleanup work. We have partners that help with that because there are some things that are more serious than a yellow light or a red light that we can't resolve. The client's got to, they've got to bite the bullet. They've got to decide to clean it up if they really want to own. But many of these cases, Bradley, we can take care of probably in 30 days or less. But the client's got to be willing to work with us. We have to have full disclosure. I call it open kimono, full disclosure. The point being that we've got to know everything, all the blemishes, and the credit report doesn't necessarily show it all. That's the other thing. There may be something like alimony or child support that is not reported in credit. So it's not an exact science, but I think if people come in prepared to learn and deal with whatever they've got in their lives, we can help them prepare to buy.
And I think in my experience, the more that buyers out there approaching this as a team effort, which it really is, Christopher, myself, and then the buyer, and we're all on the same team, kind of pulling in the same direction. So the more open you are about things on your credit, for instance, or things you may have on your debts, the easier it will be for us to make recommendations on how to solve those.
Yeah.
Good. Let's talk a little bit about, you touched on this before too, but some more, maybe 1 or 2 levels deeper around some of the down payment options that buyers have out there. I think, in San Francisco, the median condo price is $1.1 million. The median single family home is $1.3 million. Not low figures by any stretch of the imagination.
No,
so coming up with the $200,000, the $250,000 for that down payment, on top of being able to make the monthlies work, is a stretch for a lot of people. So I think the really interesting thing about RPM is that there are some options out there that are outside of the 20% down programs that you guys have. And so one of them you mentioned was First Rex, REX, and you mentioned some of the VA and the FHA programs. But for the audience out there who's interested in First Rex, let's talk a bit about that some more, and kind of again considerations and what the best use case for someone thinking about First Rex would be.
Yeah, I realize that now I jumped the gun, and I apologize. I gave you a preview of the preview. So the First Rex program is a strategic tool to help people who either don't have the 20% down, or they may and they don't want to use it all. Okay, so some people may have to liquidate investments in order to receive the 20% that they need. They may have 10% as liquid. This is a program that we have used for about 4 years. We've helped clients who were either moving up from one house to another, and they did not want to sell their existing home before they bought their new home. Well, because they couldn't sell it, they couldn't use the equity in it to help them on the down. So they only, for example, had 10% down, and we used the REX program to get them to 20. Another example would be a client who says, I really want to be in that school district, but I can't afford that home. The average price is higher than I'm approved for with X lender. Or I want a certain commute, or I want a certain comfort level with my community. Walkability is a real big issue today here in the Bay Area for first-time buyers with young families and getting to public transit. So a program like this, where let's say a buyer, you gave an example of 1.2 million, let's say they're approved at 1 million, and the price of the properties or neighborhood they want is at 1.2. A program like this will allow them to leverage their buying power, into a higher cost home without them having to come up with the additional down. So if a person has, say, $100,000 down on $1 million property, if they can get to REX and get the home that they're interested in approved for the REX program, they could probably stretch that to a $1.2 million purchase or higher. They could probably go to $2 million in that example, right? Where their 10% of 100,000 is now of $1 million, is now 10% of $2 million. Okay, when they have the REX 100,000 paired with their 100,000.
Yep.
Okay, hope that made sense. We can't stop and start again.
I need my calculator, but it's on my phone right now. So yeah.
Well, the point being that with a program like this, you can leverage your buying power by using the funds that you've got. And as I mentioned earlier, if you have this example of $100,000, but you only have 50, and you have a gift of 50, you're now at 100. And if REX matches your 100, you're now at 200,000, and you've got 20% down on $1 million purchase.
Or 10 on a $2 million purchase.
Or 10 on a $2 million.
And so, and the way that you've explained REX to me is that Rex is participating in the appreciation as well.
That's correct. Yeah. So as you own the property and you make your mortgage payments, you're paying down principal and interest. So the equity that you earn by paying down your principal is all yours. Any improvements you may make on the property during the life of the Rex agreement will accrue to you, the cost of those improvements. Rex does not participate in your equity piece, okay? They only participate in your share of the change in value. So in the example of $1 million purchase today, say 10 years from now, if you wish to take Rex out and it's worth 1.3, you've had appreciation of $300,000. In the example of 10% share split on the down payment, then they would share 60-40, with 60 being to the buyer, 40% to Rex on the change in value, okay? So it is a strategic tool. It is one that I talk to every potential buyer about, whether they're interested in it or not. We talk about it because they may have access to gift funds that'll get them to 20 on their own. They may not have to give up a share of the change in value. But many people I'll say to, look, if you don't have a program like this, would you rather have 100% of nothing, because you're not going to be able to buy your home that you want, or would you rather have 60 or 80% of something?
And you also mentioned before, too, that there are options down the road to buy out, basically.
That's correct. The agreement is a minimum of 3 years and a maximum of 30. And at any point after 3 years, you can choose to take Rex's investment out, either by refinancing the property, and typically what you do is a cash out refinance to pay off Rex, or you might sell the property. And in that case, you're paying off their investment as well, and their share in the change. The other thing is that if the value of the property declines, which can happen, and has happened in the past, then they will share in the loss with you as well. Okay, so they minimize your loss on the downside. This is not available in every city in the nation, metropolitan markets only, but the 9 Bay Area counties are open game for a program like this.
Gotcha. Very good. And I think as we approach our time with Christopher today, I do want to give you the floor just to have some closing thoughts, or if you want to ask the audience a question, feel free to do that as well.
Happy to. I'm not going to ask for raise your hand, but I think buying your first home is probably the most significant event in one's life. Financial commitment is the largest most people ever make unless they start a business. It's an emotional event because oftentimes you get tied to the property, you fall in love with it, and if you don't get your offers not accepted, it can be crushing. And I liken this to people who get in shape for an athletic event. You study the skills and techniques in the sport, and you get in shape, and then you go practice it individually or as a team member, and then you get on the field of battle with your equipment on. But if you're afraid to go compete and you leave the field of battle, you'll never get the home you want. And I don't want to make it sound like this is a difficult project. It can be, okay? But if you pair up with the right people, a lender who knows what they're doing, a real estate agent who's very skilled at their craft, and you work as a team, I find that we have great success. We oftentimes will get people into contract on their first offer as well if we do it right. And an example of doing it right is if you're approved at $1 million, don't go offering on properties at $950 to $975 and get countered to the point where you can't compete because you have to bow out of the contest. So a lot of what we do is based on our own experience. We've owned 3 homes together, my wife and I, and we've lived through the downturn. We've owned since 1986, so we were around for the meltdown. And fortunately for us, as many Bay Area people have, they've recovered the value of their property. It took some time and patience, and we were willing to be those things. I wish you all well. If there are any questions, I'm happy to entertain them. Owning a home is exciting. I remember the first time we bought a home, we had a washer dryer in the house. I didn't have to go down to the laundromat anymore. I was so thrilled. Not sharing a wall or a ceiling with someone was exciting as well. And don't forget the tax benefits of owning a home. I'm not going to go into that here, but I think you've had previous sessions where you did cover that. Thank you for the opportunity.
Very good. Well, I want to thank Christopher Caproni from RPM Mortgage for joining us today on the interview series. What we'll do is we'll drop his contact information into the comments, so if anyone wants to reach out directly to connect with Christopher, feel free to do so. And until next time, thank you guys for joining, and happy to help.
Thank you.